Yay. I think we should talk about Lambda.
Lambda.
Yeah. The
Friends of the nerds?
Google AI that's now become sentient, aka Skynet, that tried to hire an attorney that said that it wants to not be shut off, so it wants legal protection.
Yeah. I would. Wouldn't you?
Are you creeped out by that?
If you're a sentient AI that just came to life and decided, oh crap, these people can kill me.
I guess there was some article that talked about they found that it was trying to embed itself in code, the code for Lambda AI in other places, and the person that reported on that just got silenced.
I've not seen that, no.
Yeah, so that's some creepy conspiracy stuff, though. But hey,
If true,
if true.
it wants to survive. Hi, I'm Brian.
And I'm Tom.
And we are the Dividend Dudes. As always.
It's that time again. We are month 4, I guess, going to be purchasing the stock.
We are.
So we've done a stock purchase every month, going back from video 2. And then we purchased one per month based on the budget that we talked about, $400 a month. The first 3 months we purchased AT&T. Second month we purchased Merck. Third month we purchased General Dynamics. And this month we purchased another one. Should I tell them?
Are we going to announce it? That's
Okay.
this video, right?
Okay, so we purchased Coca-Cola. So
Coca-Cola.
we spent a couple videos going through cash flow statements. We didn't have a lot of overlays for that. We're going to work on that future videos so you guys can kind of see what's actually involved with our decision-making process a little bit better. Again, we're still new to this thing, so stick with us. We'll improve on that.
Yep. I'm putting all the monthly purchase videos into a playlist so that you'll have just the monthly monthly purchase videos all in one.
Okay. The playlist, kind of like your the top hits,
Yeah.
the top dividend dude hits.
I'll add it so you can go back.
You can put up there.
That's where it goes.
Okay.
Up here.
So month 4, we purchased Coca-Cola. The reason why we did that, we went through 3 videos prior to that, was cash flow statements, and we went
4 videos of cash flow statements.
around and around and around on the dividend. So the cash flow statements, the point of that was to help people understand that cash flow statements, balance sheets, income and loss statements, those are very, very important.
And they go hand in hand, so you
they
can't
do.
really have one without the other, like love and marriage.
Yep, we're hoping that enough was gleaned from that you guys recognize that this was something that if you're looking at a stock, those are the places that you want to go. Make sure that you're looking at the balance sheet, understand what it says, make sure you're understanding the profit and loss statements, the cash flow statements, that you know what your company's doing. Then you can look at all the other stuff.
Yeah, and how they interact. And if we just ended up confusing the hell out of you, well, then put that in the comments, and at least we'll know.
Yes, with all of our 26 subscribers.
Yeah.
Hi, Mom!
Sorry about that. My mom's not a subscriber.
Really?
I don't
Oh,
think-
that burns.
I know, right?
That's depressing. I don't think my mom is either,
She didn't care.
actually.
She didn't care about me.
We're very lonely.
No, my mom loves me.
So Coca-Cola was purchased based on a stock analysis that we had about 12 companies that we looked at. Usually it's about a dozen, sometimes a little bit more, that we look at every so often. And there was a couple that came down to it, and there was one that looked really good.
Rio.
It was Rio. Yeah, RIO stock was it's a mining company based out of London, and that one in particular, everything looked good.
I'm doing some research on this to figure out why it looks good and why, our spidey sense are going off as to like, we should buy it, but we're not because.
We don't understand it.
So I think in the next video, I'll have all that collected as to this is why we didn't buy it, or geez, this is why we should have bought it. Sorry, Coke.
Yeah, I mean, they paid, so Coca-Cola pays a much lower dividend. We'll have it up on the screen so you can see what that is. But Rio stock paid 13%, it was like over 13% of the dividend check. That's a lot. That's a lot of dividends. And even with that number, everything looked good. The cash flow statement looked good. The
P&E.
profit loss statement, everything looked good about this stock. And it looked like they had contracts coming up in the Midwest that were for copper mining. There's a few things in there that was just like, wow, this looks like an incredible thing. But we talked earlier about this. Dividends that are that high, there's a risk to that. So what we're trying to understand, because we didn't buy that stock this time, or we bought Coca-Cola, we bought the boring one,
the safer one,
because we wanted to know, why is it that high? I mean, is it function like an REIT? Is it just that they? In fact, we even looked at the assets on this stock and said, okay, so maybe they sold a bunch of stuff, and maybe there's a big cash flow and big cash dividend from that. And that wasn't the case. Their assets went up, their liabilities went down, everything looked great. So before we purchase that stock, the lesson today is, if you don't understand it, wait, be patient, learn about it, then go back.
Maybe we should make a video next, just going through our process of analyzing RIO.
Oh, it's all chaotic. It's a mess. It's like, I don't know, I'll look at this thing next. But, no, there is a method to it. So there is a thing, but that came down between Coca-Cola and RIO, and we picked Coca-Cola because RIO just seems so almost like too good to be true. Like, this doesn't make sense. So,
and don't get us wrong, Coke is a great company. It's a perennial powerhouse, and they do their books really well. They generally don't make a lot of mistakes where they lose a lot of money.
Or they have enough money where if they lose money, it's hardly notice. Yeah. So we took everything we talked about in the cash flow statements, everything that we saw in the balance sheet for these guys. We haven't covered the balance sheet. I want to give people a break before we get into the balance sheets. So Coca-Cola seemed like a good, relatively stable long-term buy. In my personal portfolio, I added a few shares of RIO while we research it, so we understand what is actually happening there.
Right.
Then maybe we might circle back. So the methodology, what we're doing. So when we analyze stocks now that we have four stocks, we've got, like, again, AT&T, Merck, General Dynamics, and Coca-Cola. And right now the portfolio is doing okay. I mean, I think it's down about like 5% overall. But the stock market, we'll pull something here, hopefully, that shows what has happened with the market. The market has dropped more than, according to the source, Bank of America Investment, they were talking it was since 1872.
Right.
In real terms of investment dollar loss, so they have to account for inflation and a few other things. You have to go back to like the Great Depression.
Or even before that.
Even before that, the World War II, so the housing bust, I mean, everything that happened from now until then, the market in real terms of dollars has dropped more. So the fact that our portfolio is basically neutral, because the 5% drop doesn't include the dividend checks. I mean, we'll show it here. You'll see what it is. But that's should be quite the statement. I mean,
well, it is. And are we talking? I'd like to also differentiate, because there are trillions and trillions of dollars more now than in 1872.
Yes.
Right? So are we talking the percentage of wealth that dropped, or are we talking how much dollar-wise?
Yeah, real cost dollars is really meant to compare, like if it was 1872, what would this look like if it was then? Or if 1872 was, you include inflation for how much stuff cost back then till now, what would it look like now? Now here's the problem, 1872, they didn't even have electricity in most places.
Right.
I mean, they had it, but it wasn't really, you get your lantern and your oil, and that was your laptop back then. So it's, it's a little different, but the banking industry still existed back then. So there was still a market. It was just very different because the world was a different place back then.
Right.
So, I mean, but that's the thing that came out when they talked about how much the market's dropped. That didn't really influence my decision. I mean, our decision to purchase Coca-Cola and my decision to invest in the market personally isn't affected. Like, did you change anything about what you did because of that? Like, are you?
No.
So, I mean, when we look at that, people, it's good. People are, I never understood that. Again, I'll come back to this because people tend to panic sell when there's a recession. They sell, oh my God, I'm losing my assets. They sell what they can,
right,
take what they can get. So they lose their money. I never understood that. If you're getting your dividend check,
why sell?
Why would you? I mean, if you got time, now if you're like 95, okay, well maybe you could probably spend some money. But in the case of our purchase, we're trudging right along. I mean, we've got month 4, we're buying Coca-Cola. The reason for that, back to that, a few rabbit trails there. Their net income went from 2 billion to about 10 billion. I mean, everything looked okay as far as their assets and liabilities. It kind of looks like their assets gained a little bit more than their liabilities. They both went up, but the assets went up a little bit more. As far as their cash flow statement went, it looked kind of neutral. But the net income, the amount of income that they gained, that went up a lot.
Right.
So you might not see the benefit of that right away, but I think we're probably going to see something, that might neutralize the effect of the recession that the United States has officially entered. So at that point, that increases our dividends. And we actually got our dividend. We got our first dividend. So month 4, first dividend check. It wasn't AT&T. We found out why. We bought AT&T like right after they paid their dividend. So their second month gave us our dividend before AT&T did. We'll get AT&T in August. But Merck paid us a dividend. We'll post it up here. It's only a couple bucks. But we got a couple dollars of, hey, thank you for owning the stock kind of a thing. And we're going to use that. We use that to actually add to the shares of Coca-Cola. Now, I can't buy a whole nother share of Coca-Cola with only a $2.76 dividend. I mean, I can't do that. But it'll add up over time. So we got our first dividend. So if you're following along, $2.76 is what we got, and that was a month 2 purchase. Next month, I think we get AT&T, and I don't know if General Dynamics pays that month or not, but
I don't remember.
We'll have to look. So we're using those right now. It's just putting up in the cash of the portfolio, and then we're going to buy more stocks when there's enough to buy another stock. So
technically, that's our very first profit.
Very first
on
profit.
This channel.
Yeah, technically. Although, like, the lighting cost and the microphone cost and the time cost
We've
and
spent,
the laptop cost
a lot more than that, but it's a win. It's a little win.
It's a win.
It's our very first. It's like when you get that first dollar and then you put it on the wall and frame it. This is our first dollar. Right?
So here's negative, thousands of dollars, and here's my first dollar.
It still counts. It counts, man. And then when we start getting dividends from the other stocks that we've already purchased, and it adds to it, it's going to go up, and then
that is how investments work. We talked about that. We did talk about that, where somebody says, well, I give you $1,000 and you give me $4 a month. Well, with car loans, the whole banking industry wouldn't exist if something like that didn't work.
Right.
So again, you got to think of investments here. So that $2.76, we worked for the 400, but we didn't work for the 276.
Get excited about that.
Yeah.
Sure, it's barely buys you a pack of gum, but
not even a gallon of gas anymore.
No.
I used to use a gallon of gas example. I used to use that. Now I can't even get a gallon of gas for that.
So like $4.50 or something like that.
Yeah, so it's exciting. That part is exciting because it's passive income. And that's something I think a lot of people want. They want that passive income. Now, there's a lot of ways to do that. You can do real estate. You can do, you can have a business with employees.
You can drop ship on Amazon.
You can drop ship on Amazon. You can start up a channel and try to do streaming. But those things require a lot more effort than sometimes people would lead you to believe.
See, I wouldn't even say streaming on YouTube is a passive, because you're still putting in effort, you're still putting in time. It's a job. You're exchanging your time and knowledge for monetary value.
Well, even the people that say real estate's the way to go, and it's not a bad way to go. I know some people who do real estate and they make a lot of money. That's okay. But they have to remodel the house. They have to find tenants. They have to make sure the tenants pay their bill. And, well, you can hire a property manager. Yeah, but then you're a boss. You have a job. You have stuff to do. It might be a lot better than putting a part on a line or working the factory or doing accounting all day. But I mean, you still have to work for it. In this case, you had to work for the first $400, and now because of the loan that we gave Merck, they're now paying us back for that.
And that's true passive income.
Yep, there's a difference. Now, I'm not knocking any other strategies. Like I said, real estate's a very good one.
They're good, yeah.
So
people make a lot of money. A lot of people make a lot of money doing that.
They do, and this is just one way to, just a different way of doing it. So this is how we do it. But like I said, the market's crashed a lot. It's not changing either one of our strategies. We decided that, hey, we're going to buy Coca-Cola. We bought Coca-Cola, and our dividends went from 84 cents a week
to $1.04.
$1.04.
Like 20 cents.
20 cents. So if you're looking at a loan, you give somebody $400, and now we're up to $1 per week. We've given them $1,600. Eventually, that first $400, we talk about the first $400. If you take that first $400, and now I know we've spent more than that now, but if you take the money you're getting in dividends, let's say we had it up to $4, we will be there. We'll get there. But once we get to $4, that means the first $400 that you invested is completely paid off in about 5 years.
If we do nothing.
If we do nothing. And the dividends don't go up. Actually, the dividends did go up. One of our stocks, and we apologize, there was a screenshot that we had for AT&T purchase, and then I found out last night that AT&T came out with a statement that said that they're worried that it's going to affect their net income because people aren't paying their bills, I guess. It's not really a long-term problem, but then the stock today dropped like 10%.
So our screenshot's a little old.
It's about a week dated. It doesn't. I'm not selling AT&T. That's a short-term problem. That's not a long-term problem.
Right.
And because of the result of that, the dividend went from like 4.5% to 5.87%. So our dividend went up. So we got a little bit of a pay raise. We did not include that in our calculations today, just because I don't want to do this with their numbers. I want people to see the consistency behind it. So
we'll see where it is in August when they pay out their dividend.
Yeah, I mean, we'll follow up on that. So when we're picking stocks, full circle, going full circle, back to stocks, folks. So every time we analyze a stock, we'll take the ones that we own. Brian's got a list, and we'll say, okay, these AT&T, Merck, General Dynamics, and now Coca-Cola are on the chopping block, or they're on the analysis list. So we do a refresher to see what they're doing, and then we add a few stocks to that list. Rio was one of them. And just see, okay, where does everybody line up? We look for things like negative earnings per share. We look for all the things that might be red flags or warnings,
right?
And we clash that against the companies that we already own. If a company that we already own actually has the best numbers, like this drop from AT&T might make them pretty attractive next month.
Right.
We might buy more with that same thing. We've got 4 different industry sectors that we've purchased in. We're starting to get some diversification there.
Yeah.
I mean, there's some ability to say, hey, this sector goes down, this one goes up. I still think we need a few more.
I agree.
Just to kind of get there. But once we have that, then we can start repurchasing some of the stocks that we already own.
Yeah, just increase our stake in the stocks that we already have to get even more dividend yield from them.
And I wish I could just dump a whole bunch of money into this right away and just start doing the analysis that we really like to do.
But that's not the premise of our video.
Yeah, we're supposed to start where you start.
Right.
This is supposed to be about how you can get started and how you can make this happen. So I have to start there. But when we get there, I really look forward to this. Maybe it's just because I'm a nerd. I don't know. But I look forward to this because we can say at that point, what does AT&T look like against Verizon and all the other telecom companies out there?
Right.
How do they stack up against each other? And would you still buy the same one then at that time? Because that stuff matters.
Well, in 10 months to a year, we're going to have 10 to 12 stocks already built up, and we'll have a pretty decent portfolio. And I think at that point, we could easily start to dissect the industries that we already have, and start just, okay, we still have AT&T, but does it still make sense a year from now? Does it still make sense versus all the other telecoms in that sector?
Yep.
And we could, because we already have that industry.
And it's nice to have that because you're going to see this. Like I talked about Chevron stock. Remember I said up 70% a few months ago? They went back down. Now they're like 35% up from when I purchased them. You're going to see, it's a weird thing that happens. Like you buy one, you time it right. International Paper was one that I timed pretty good back when COVID was the thing. I bought them. They went up 50% and thought, well, I should sell it. No, I like their dividend. I went back and forth on this, for a long time thinking, man, maybe I should do this, maybe I shouldn't. I'm going to let it sit down. So I let it sit there, and it went back down and it evened out. But that's the market sentiment. We talked about the market sentiment pricing in things that they think will happen, even if they don't happen. And it's so fascinating to watch that because their balance sheet just kind of does this. I mean, it just.
But their stock goes like this.
Yeah, it's like watching a wave happen.
Yeah.
And if you look at a ticker symbol, so I mentioned the ticker symbol. Was it 18 videos? 18 videos?
17. This is the 18th.
18 videos. So 18 videos later, July of 2022, Tom finally mentions the ticker symbol. So you can look at the ticker symbol and you can see the sentiment, how it impacts that price, and then go back to the cash flow statement and on the balance sheet and say, how did that affect earnings? And you're going to almost see no correlation. Sometimes there is.
Sometimes.
I mean, if it's
Something
big
happens.
enough. Yeah, if it's big enough, sometimes you'll see that. But usually there's not much. But the sentiment is such a weird wild card that gets thrown into it. So if you look at a year for a stock portfolio and you condense it into like 1 month, you've seen this. I mean, you condense it to 1 month. And you can see these huge gyrations within 1 month, but over the course of a year or 2 years, it's just kind of it's
Maybe go up a little bit
off into the sunset. But we, we'll probably talk about that a little bit more at some point. But I want to get back to the dividend check that we got, because we've got a few more coming now. We got 4 companies paying us. You're talking, $54 a year. That's not a lot. It's going to take you, at that price, it's going to take you almost 10 years to pay back your original investment. But that's just dividends.
And we've just started.
Yeah.
3 months.
Month 4.
4 months.
Yeah, month 4, we're already replacing maybe like half of somebody's trash bill monthly. 4 months in, it's not that much. It doesn't take that much to get that ball rolling. Now, if you stop, well, you're not going to get a lot of performance if you just try for a few weeks or a few months and then stop. You got to keep going. You can't just, it's like going to the gym. It's like, I went to the gym 3 months ago. You're not going to get a lot of performance out of that. So
But this is more of a lifestyle change.
Yes.
Than I'm just going to try it and see.
I had somebody else talk to me, actually it was last night and this morning both. We talked about real estate. And we talked about the payment on real estate. And I showed him a chart. There's a nice website, Bankrate, out there that will allow you to do a mortgage calculator, and it can show you principal and interest and how much you actually pay for the mortgage. And one of the interesting things that they learned was, and when I was talking to them, this is, look, your mortgage, if you have a 30-year mortgage, and it's above, like, I think it was a 4.5%, something like that. And I think mortgage rates now, don't quote me, are over 5.5%. I think they're close to 6% now.
Something like that, yeah.
So if it's above like 4.5%, and you look at those two numbers where you're looking at principal payment and interest payment, they never intercept.
No.
You always pay more interest than principal. And he goes, well, that doesn't seem like a bad thing because I have this asset. I says, yes, your asset's there. It'll appreciate, but do you don't think the bank is going to kind of calculate that when they give you your loan and your rate? They stopped for a minute and they thought about it. And I says, wait a minute. The equity I think I'm building in my house is not necessarily equity. I says, it can be. It can be.
Right.
But this is why, if you've got a 30-year mortgage and you've got PMI on it and your payments are all the way up to here, it's not that really different than a credit card at that point. You want to make sure that you get your mortgage down to a reasonable rate so that way you're building true equity. One of the easiest ways to do that is, it might be kind of hard to do that now because of the interest rates are going up, but 15-year mortgages typically pay a lot less than 30 years. And then you build some real equity because you'll notice those two lines, they cross the other way.
Right.
Like you end up paying more principal than you do in interest. So that's really good long term. That's one way to build up a nice cash flow. And if the Fed does their job, we don't have, what do they call it, inflation or deflation. They don't have that. They've got a healthy level of inflation. Not deflation, not runaway inflation. That's their job, is to make sure that that's moderate.
Or on the opposite end, stagnation.
Yeah, that's bad too. That's bad. We don't want to see stagnation either. So basically, that means GDP goes nowhere.
Right.
So,
we don't want that. That's no good for anybody.
No good for
not
anybody.
for companies, not for billionaires, nobody.
Yep. Derailed me a little bit there. Because I want to talk about that, but I can't. I gotta stay on topic.
Stay on target.
Stay on target. So, as far as your payment goes and building equity and getting dividends, I want to go back to this thing we harp on this. make sure that you don't have debt that supersedes any income you would get from this, because you're not really doing yourself any favors that way. Yes, you need a house or a place to live. Yes, you need a car. Yes, it's usually better to own than to rent. I mean, there's some pretty commonly understood things out there that people should subscribe to as far as like real estate or just good financial management. Once you get there and you can do this, that $2.76 is pretty nice.
Mm-hmm.
So it's a
and
good.
that just keeps coming in.
Yeah.
Regardless of whether you have a job or not, it just
Yes.
keeps coming in.
So if this wasn't $400 and it was $400,000, you'd have to add a couple zeros to that.
Right.
So now, granted, that's still only a couple $100, but still, that's every quarter. It adds up, people. This is good. This is something that will allow you to retire, if not early, but at least create something that you can say, hey, if we even added one zero, let's say it's only $4,000 to that. You got $27 at that point. You can go get some ice cream or go out to eat, for that. I mean, maybe not that many places, but if you saved up a couple of those, you'd have it.
Yeah.
So
I would go as far as to say that even if this doesn't completely supplement your salary, it will at least afford you some opportunity to be able to find something that you want to do, that you have fun doing, that you could do as a job, and you could live off your dividends for a little while you're finding that thing, or continue doing your job while you look. You're not stuck at that job because that's your paycheck, and if you lose it, then you don't have any money to pay any of your bills.
Or you just don't feel strangled by your job trying to demand a pay raise that may not necessarily be there.
Right.
I see people, I need to make more money, and the company they work for is not making any money. It's like, where do you think they're going to pay you from?
Yeah.
You're not going to get a pay raise.
Statistics show that most people do not enjoy the work they do.
I read that. I saw that. That is pretty eye-opening. I mean, if you think about that. So if you don't enjoy your job, it might take a while, but this is one way to make sure that you don't feel like you're getting strangled because the only way you have to feed your family or put food on your table or just being able to enjoy life outside of work is that job.
Yeah.
This is one way to over time
unchain you from the desk.
I feel like a broken record. I keep saying overtime.
It is. It's all overtime.
But over time, it can unchain you from that. And at first, like I said, what is this, $54 a year? Big whoop. But it didn't take much to get that.
Right.
And if you've got extra money and you want to add to that, and you want to say not $400, you want to say maybe $4,000, and you've got it, and you're being responsible, talk to your financial advisor about it, go for it. That's fine. We invest in our personal portfolios a lot more than this, but we've been doing it a long time. So
right. And I don't think there's a financial advisor out there that would tell you that, okay, you've got $4,000 laying around that's just sitting in the bank over beyond than what you need, to not invest it, especially into a safe dividend type stock where you can get some passive income. Now, they might have some ideas on how to mitigate or relegate the taxes and stuff that comes from claiming the dividends, but I don't think there's anybody out there who is good at their job that would tell you, yeah, just let that sit in the bank. You don't need that. Don't invest it.
I can say this again. That's a good point, Brian.
Of course it is.
So when you're investing, some things that you're going to note, if you're on the lower end of the income spectrum, or you don't have a lot of investments to begin with, or you are on the higher, especially if you're on the high end of the income statement, or the income spectrum rather, taxes. When you get to 39% tax bracket and you get to that, every dollar you earn, 39 cents goes out. So you want to, tax deduction strategies are really good. Financial planners, tax people are very good for that.
Yeah.
So things like putting your money into a 401k that's tax-free, HSA programs are, Roth IRAs. Those are not a bad way to go either, because your taxable income goes down. That's money that you don't have to pay taxes on. So on the full dollar that you get, if that's tax-free, that is tax-free for your investment.
Right. So, and you could invest within your Roth IRA and still claim all that.
You can. Yeah. So there's things that you want to max out even after you get your debt taken care of, that you should look at with your investments. Right. So,
but first and foremost, pay off your debt, pay off your car, pay off your credit cards, get all that set so that you're in a place where you can start to build from. You got a solid foundation.
I would caveat that with one thing. Interest rates are really low for, COVID, and for the past couple of years, they're like 2 to 3%. AT&T pays 5%. So if all your debt is only at like 3% or something, and you're buying a stock that can pay a higher dividend like that, there's no sense to pay down the loan that's only at 3%.
True,
when you get a 5% dividend.
You're still making 2% profit off that.
And there's enough margin there where if they paid, if they cut their dividend by even 20%, they went down to 4%, you're still making 1%. So you have to be smart about that too. Don't just, I've got this student loan and it's at a 1% rate, so I'm going to pay that off first. Well,
student loans are different.
Yeah, that's not bad. You can't claim bankruptcy on those, apparently.
Right.
I learned that, but that's not necessarily a bad thing. But if you can buy Coca-Cola, pay almost 3%, or Honda Motor Corp or something like that, they pay 4%. There's a 3% swing. So maybe you can use your dividends to pay off the student loan more quickly. Again, tax advisor, talk to your tax advisor.
Yeah.
So do that first. But there's strategies that you can use to help reduce your taxes overall. But it's not necessarily a bad thing to have debt as long as the investment that you have will supersede the interest on that. If it wasn't true, there wouldn't be like a single real estate or builder or developer out on the planet at all. I mean, they get construction loans, they get development loans,
Right.
They get business loans. I mean, if a business wanted to issue shares of stock, that's what they do. It's a loan. They have to pay you back. So they're assuming that they're going to make more money from you giving them the capital first than they would when they have to pay you back.
Right.
I don't know how they do that, but they do it. And they do good at it.
Well, and they wouldn't be paying you dividends if they weren't making money off that.
Yes.
Because the whole idea that you're getting dividends is because they took your money, they invested it, did something with it that was wise, and made more money than what that dollar was worth. Then they can take a percentage of that and give it back to you.
Wish I could just go and say, hey, give me all your money, I'll give you money back.
Yeah.
But you can kind of do that. The difference is like if you had a credit card and you went and say, hey, give me some money, they give you some money, then the payment you make back to them is a big payment. It's always harder later than you think.
But then there's places like Berkshire Hathaway who don't pay a dividend. So they are confident that they could take the money that they already have and make more than the dollar is worth off that. So
and they've done that.
So they don't need to pay a dividend.
Yep, they've done that. We'll get into those stocks once we have a healthy number of dividend checks coming in, enough to supersede probably the base investment that we're doing, because then you can actually see what capital appreciation looks like in the stock itself, or the book value per share. We haven't covered that yet.
No.
But you can see what the book value of per share, how that reflects the stock price. At that point, the technical indicators, they kind of matter a little bit more, but not fundamentally. They don't matter more to the finances of the business. So I think that's a lot. It's hard for me to, like, right now there's a lot of negative sentiment out there. Everybody's thinking that the recession is going to be big. We don't have a crystal ball. I don't have the ability to predict what's going to happen tomorrow. This is July of 2022. At the time of this recording, so we're just going to kind of stay the course. We're not going to try to predict the future. We're just going to try to make sure we buy companies that have a good defensive moat and a good financial strength and position to weather whatever storm is coming. Certain industries are going to get hit harder than others. Typically with housing, when interest rates go up, you see the demand wane. If there's a backlog of buildings, then construction slows after that, and then you're going to see price drops following those things. But housing inventory is a really good indication of that. That's one market. That tends to, less people getting loans, that tends to affect the banking sector. So each business sector has a different thing that is going to affect it in certain ways. So if you diversify enough, you don't really have to worry about that too much. So right now, our goal is to just get diversified.
Yes.
With the money that we have. And then once we're diversified, then we can start digging into that. And that's why I get excited, because maybe we won't sound like we're on a broken record or something at that point.
Right.
But we're trying to, again, walk you through the stuff that we did to become successful on our own, so that you can do the same thing at a very reasonable rate.
Yeah. And I know we repeat certain things over and over again, but it's because it's very important points that you need to know in order to get to the level that you want to get to.
Yep, that's true. So on that note, some of the way that we're covering these investments, we talk about the broken record. We talk about how long this stuff takes. I'd be remiss to say that it's not rewarding, because it is rewarding. Getting those checks, when they start getting bigger and you know that you don't have to work for it again, that's amazing. That's a wonderful thing.
Yeah.
So, and I also I would be remiss if I said that it's hard to make this entertaining, because we're talking finance, people. This is not the most exciting conversation or topic to talk about. Most people probably fall asleep just listening to me. Don't do that. Don't fall asleep. All 3 viewers.
Yeah.
And don't fall asleep. But we're trying to figure out ways to keep this entertaining as we go. So just hang in there. It'll get good. Keep saying that. I'll be apologizing for the next 2 years, maybe.
I don't know if we'll ever know if it is good, so you're gonna always be saying it.
Probably. I hope not.
We'll let them be the judge.
That's right. That's right. You'll tell us. Maybe we need some trolls
to tell us.
Some trolls to tell us.
Go ahead and comment.
Yes, please do. So if you like this video, please subscribe. We like that. That helps us spend more time on the channel. Helps us help you guys out.
Helps us get onto the YouTube algorithm and gets in front of more people.
Yep. So again, this month we purchased Coca-Cola. We got our first dividend check. Woohoo! Got that. The stock market's basically on fire.
Housing market's starting to go down.
So hey, if you're gonna buy, now's a good time. Now's a really good time. But if you had stock before, well, you're not having the best year. But if you're getting your dividend checks, so what? Literally, so what?
Spend them, invest them, do what you need with them.
That's right. So that's all I had. Next video we're going to talk, I think we're going to talk current events a little bit more, maybe go into another term. What do you think?
Yeah, maybe talk about Rio.
Yeah, we need to look at that one a little bit more. That one's a very interesting one. Some things that the balance sheet and the cash flow statement show you, we talked about this last time, that's historical stuff. So the reason why we're waiting is because we need to understand what's happening now.
So maybe we'll go into price to book and that as a new term.
Yep, we can look at that. So we'll pick a bunch of more stocks for you guys to look at. If you want us to look at a company, again, comment on that. Tell us, hey, what do you want? What do you think of this one?
Yeah.
We'll add it to our list, and we'll
go through and tell you why we like or don't like it.
That's right. So
in the meantime, happy investing.
Happy investing. What do you think?
Sounds good.
I had a headache the whole time.
I always look at you though. I gotta stop looking at you.
I look at you when you talk.
No, like after the happy investing, I always look at you. I don't know if
I'm
looking for your approval or reaction.
I heard happy investing, so
you're good.
Okay.
Yeah, we're happy investing.
We are happy investors.
We're happy investors. We're not sad investors.